Hello you lovely people, welcome to our next video on AAT level 3 advanced bookkeeping chapter number 7 from BPP textbook, inventories. Well, inventory is a major part for any business. Inventories are recognized as a current asset into SOFP. Also, both opening and closing inventories are treated in SPL. Opening inventory is treated as an expense and closing inventory is reduction in expense. Where do you treat this to? Into cost of sales. Inventories, according to IAS 2, we record inventory. Inventory is one of the major parts for any business. Even big businesses, they pile up loads of inventories. So inventory management is an important task, and this is an adjustment. So closing inventory, because it's a current asset, statement of financial position, debit, and closing inventory in SPL we deduct from cost of sales. Under the cost of sales, that's why SPL credit. And closing inventory items are unsold during this year, during current accounting period. The same closing inventory becomes opening inventory next accounting period. There are quite a few things you're going to learn in this particular chapter. Cost, the valuation, especially cost, net realizable value, FIFO, LIFO, call a little bit, not much. Okay, and yes, inventories are held for sale into the ordinary course of business. We keep these inventory to sell in the business. In the process of production, like we buy raw materials of inventory to make products and goods just for selling purposes. And it's based on IAS 2. It affects two ways. Number one, we already told you, statement of financial position, a large balance with a current asset, and statement profit and loss, SPL, it is opening and closing inventory, direct impact on the cost of goods sold and profit. You know, the cost of goods sold affects their profit. Yeah, we're going to check it out slowly and steadily in this bit, cost of goods sold. Okay, just taking it straight down, what is the cost of goods sold? This makes your cost of goods sold. Opening inventory plus purchase plus carriage inwards less closing inventory equals to your COGS, cost of goods sold. This is a statement of profit and loss extract, trading account, mini income statement. Like whatever is the sales value, let it be there. Let's assume sales is £100. Opening inventory is 5, purchases are 70. Let's assume carriage inward is 5, and closing inventory minus closing inventory, this is going to be minus as any figure. And is what? 20. So 5 plus 5, 10, 70, 80 minus 20, 60 is your cost of sales. Take away from the sales, 40 should be gross profit. That's just an example. But look at these people. What does an opening inventory do? Opening inventory and purchase, these two are part of cost, doesn't it? So does carriage inward. What is a carriage inward? Carriage inward is purchase related expense. Material purchase related carriage, transport cost, that's your carriage inward. There could be carriage outward, which is sales related transportation cost. These are given here, carriage inward and carriage outward. But look at this on this picture. You know, your closing inventory can affect your cost of sales and thus profit. If you're closing, remember, the higher the closing inventory, the higher would be the profit, gross profit. Why? Because closing inventory makes your cost down, cost of sales down. So if your closing inventory higher, is your cost of sales is going to be lower and your profit going to be higher. And if it is opposite, you're gonna get opposite answers, like profit will be lower. Closing inventory adjustments, we need to do the journal, and there is a quick straightforward journal is you need to remember. And closing inventory is a current asset into the statement of financial position, that's why debit, and into the SPL we minus it from cost of sales, that's why it's credit. And the narrative. Wherever there is a journal, you need to write a narrative. Narrative is year-end adjustment to record closing inventory. There's an assessment focus point. Let's check it out. In the assessment, you may need to record closing inventory as an adjustment in the extended trial balance. Yeah, that's what you're going to check out in chapter number 12, and record in the correct SOFP and SPL column. Therefore, it is important to learn accounting entry to record inventory. Yes, we need to know the entries of inventory well, when to record as a current asset as in the SOFP, when to record into SPL. Yeah, although you'll not be required to prepare a state of financial position, you don't need to, neither a profit and loss account, SPL. It is useful to understand the relationship between inventory and other components of accounts. This process is demonstrated in Activity 1, especially Part B. Check it out, Activity 1. Excuse me. Activity 1, recording inventory in the accounts. During the year end 31st December 2017, Colin opened a business selling telephones. That's great. He bought 50 phones for 20 each. So 50 times by 20, you get purchase price. Just hold it. Then sold 15 for 30. 15 times by 30, you get selling price. Ignore the VAT. Now, bought 50, sold 15. How much is left? Let's take the calculator on screen. 50 minus 15 equals to 35. That's your remaining items, unsold. And these are your closing inventory for this current accounting period, 31st December 2017. 35 item closing inventory. Now the question is, how do you value closing inventory? Closing inventory valued at either cost or net realizable value. NRV we call it net realizable value, whichsoever is lower. Whichsoever is lower. If your cost is, let's assume, what is net realizable value? Sales minus sellable cost, we call it. Sellable cost. Or just sales, how much you can sell it for. That is your net realizable value. Our cost here is £20 each, and selling price is 30. So which one is lower? Obviously, cost is lower. So inventory should be valued at lower cost or net realizable value. That is what being said by IS2. Why? Because this is because of prudence concept. Prudence concept. Prudence concept says, do not overstate your assets. This is a closing inventory current asset, so we are not overstating. Do not overstate your profit. So we are not overstating our profit either. So this 35 items should be valued at 20 pound. 35 times by 20. I'm going to get all the calculations handy on screen. Then I'll jump into the real question. 35 times by 20. 700 is my closing inventory value. Because 35 items left, 20 each valued. Then my purchase price, 50 times by 20. 50 times by 20 is £1,000. That's my purchase, £1,000. And sales is 15 times by 30. 15 times by 30 selling price each is 450 is my sales. Yeah, sales, purchases, and closing inventory. Now people, you need to remember this structure of cost of sales. Sales less cost of sales, you get gross profit. That's what you must remember, which you might have learned in earlier, or if it is not, you need to learn now onwards. Opening inventory plus purchase plus carriage inward less closing inventory is your cost of sales. After purchase, there could be less purchase return. Even after sales, there could be less sales return. Yeah, that's what you're going to learn better in final accounts preparation. Okay, so in this particular one, we have done all the working so far, but prepare the journal for closing inventory and include a narrative. Closing inventory is a current asset. So we need to choose this one, SOFP debit and SPL credit. Closing inventory debit, 700 is the closing inventory, and closing inventory credit. But in SOFP, statement of financial position, because it's a current asset, that's why it's debit. And in SPL, we're taking it away minus in COGS, cost of goods sold. That's why this is credit. Now, what is the narrative? It's a recording of your closing inventory. That is the narrative. Being the year-end adjustment to record the closing inventory. That's my narrative. That's my full marks. Okay, complete the financial statement extract. Number B, a statement of profit or loss for the year. We have a B, profit or loss, and a statement of financial position. Super duper. Let's do it right now. Okay, what is my sales? If you remember, my sales is 1,000. How? We are selling, how many items at the top here somewhere? Yeah. No. Sales is 450, doesn't it? My sales is 450. 15 items only we sold at 30 each. And purchase is 1,000. Yeah, so just changing a little bit, taking my eraser, changed it. 450 is my sales, cost of goods sold. There is no opening. Opening is 0. Purchases are £1,000. Actually, we do in another column, but anyway, closing inventory is 700. 1,000 minus 700 left is 300. Basically, this is known as your COGS, and 300 is taken away from sales less cost of goods sold. You get GP, gross profit. 150 is your gross profit, and gross profit happens from operating activities, buying and selling. After the gross profit, you do what? Less expenses, don't you? Less expenses. Loads of expenses are here taken away, and you get profit for the year. Well, statement of financial position is a 3-column: cost, provision for debris or accumulated debris, get net back value or carrying amount. Okay. There's a non-current asset, property, plant and equipment, cost minus accumulated debris, get carrying amount. Current asset, inventory. Which inventory should be your current asset? Closing inventory is your current asset. 700. Receivables also current asset. Bank also current asset. 7,891. £1,000 is your total current asset. 1,000. And you have non-current assets 1,500. So altogether it's 2,500 is your total asset. And that's all from first video. Check out the next video to find out inventory, quantity and valuation. Till then, goodbye.